When I first heard the name coronavirus, I was like, wow, this sounds great. A bunch of people finally found their beach, just like on that commercial. I mean, now they're probably stuck on that beach, which isn't great, but it's still better than this Michigan winter that I have to experience. Then I saw headlines like this about the coronavirus shock delivering double-digit hits to the stock market, and I was like, well, yeah, of course. I mean, if everyone's on the beach, then no one's working. Productivity is gonna grind to a halt, and then, yeah, the stock market is gonna fall. So I looked up where I could get some coronavirus because I'm tired of working too, and I love beaches. I'm great at tanning. I get super dark, and then more cops follow me around. It's awesome. But it turns out to get that beach feeling, you gotta eat some snakes with rat seasoning on top of it, and then your lungs gotta collapse. So at that point, I was like, wait a minute, something is off here. Why would Corona start this coronavirus movement hashtag thing if you couldn't even get the feeling from their beer? In my professional experience, that just sounds like a bad business move. And I'm not the only dumbass who had this train of thought. This headline from Vice, a disturbing number of people think the coronavirus is related to Corona beer. Newsweek had outrage at bar offering Corona beer deals during coronavirus outbreak. How could you discount this beer that's killing people? Corona's marketing department is probably so pissed. They're thinking, why? Why couldn't it just be a Bud Light virus? And obviously I'm just kidding about all this, but my story is just as stupid as the headline saying that this market drop is because of the coronavirus. It's not. So in this video, we're going to talk about it, explain what happens with these virus outbreaks and what happens to the market, and we'll figure out where the market's going to go from here. But first, as always, if you have not checked out our explosive stocks checklist, check it out because it lists everything we use to find the stocks that we find. Very handy, very useful. Link down below in the description and comments. Just throw in your email and I'll send it to you. All free. Do it. Okay, so what's up with this virus? Well, let's go to our best buddy Alex from Macro Ops, who is not a doctor, but he's pretty good with markets. So the first thing you want to do when you're dealing with the virus is look at the base rate, meaning what historical examples, if any, can we compare the current outbreak to and how have those instances impacted the markets? Is there actually reasoning behind the market dropping because of these outbreaks? If you look at this chart, well, no. So the HIV/AIDS scare, the 80s, Reagan. Okay, the market did drop in that case, but for the rest of them, the market was generally up. The pneumonic plague, real casual, 8% return in that 6-month time. SARS, 14%. The avian flu, almost 12%. Dengue, 6%, and etc., etc. The vast majority of subsequent returns following similar historical instances have been positive. And that's not surprising because the market tends to go up more than it goes down over the long haul. So really, I don't have the specific data, but I seriously doubt that there's a long-term correlation between the outbreak and the stock market. Unless it's like the Black Plague. If we get a Black Plague, then yeah, the stock market might crash. But a lot of us would be dead anyway, so whatever. And Alex makes a good point here that if the coronavirus was going to cause a huge stock market problem, then we would have seen that reflected in prices way before this became big news, because markets are smart like that. Barton Briggs, who's written some real great books about the market, he said this: the British stock market bottomed for all time in the summer of 1940, just before the Battle of Britain. The US market turned forever in late May 1942 around the epic Battle of Midway. The German market peaked at the high water mark of the German attack on Russia, just before the advanced German patrols actually saw the spires of Moscow in early December 1941. Those were the 3 great momentum changes of World War II, although at the time, no one except the stock markets recognized them as such. This to me confirmed the extraordinary and unrecognizable wisdom of market crowds. The stock market was predicting the war way before the news was. And really, if you want to be smarter and get better returns in the market, then turn off the news. Don't listen to these stupid headlines. These guys don't know what they're talking about, but also they don't really care because the whole point is to get you to click so that they could have ad revenue. Kind of like why I put clickbait in all my thumbnails and all my titles for these YouTube videos. Everybody wants you to click, but then I give you some good stuff in the actual video, so we're different. Don't compare me to them. But yeah, news is not going to help your trading and investing. Listening to headlines is only going to hurt you. Turn it off. Turn me on though. And it's funny that people focus on this foreign coronavirus just because it's exciting, right? But in fact, the flu right now is killing way more people. And we had a great comment by Dr. Tetraman Flakes, who is a fish doctor, but his knowledge extends into human viruses as well. So he said influenza has already sickened at least 13 million Americans this winter, hospitalized 120,000, killed 6,600. And the flu season hasn't even peaked. In a bad year, it kills up to 61,000 Americans. Worldwide, the flu causes up to 5 million cases of severe illness. illness, kills up to 650,000 people every year. And all my doctor friends have confirmed it, that the flu is horrible this year. And they say the anti-vaxxers won because no one got their flu shots. And that's true too. All the people I talk to, they tell me they got the flu and I'm like, well, did you get your flu shot? And they're like, no. What do you expect? But it's really, really bad. And maybe if we focused on that as much as we're focusing on a coronavirus, then everyone would have got their flu shot. Maybe I make a flu shot video next year just to remind everyone. I got mine in August. But okay, that's your public health tip for the day. Get your shot if you still haven't got it. Now on to markets. So this is a day or two old, but you saw what happened. The market dropped and now it's rebounding a bit. But this is natural. You're not going to get a straight drop down. Well, usually anyway. So what Alex is expecting is a 5% correction. So right now what the market is being torn between is 3,300 and 3,200 down here. So he thinks we'll go back down to 3,200 right around here during this correction. And the way corrections work is they usually zigzag. So they'll go down and then have a few days up and then reach a new low again. So I'm still expecting this other shoe to drop, even though things looked okay the last 2 days. And you'll see 3,200 is right by this 50-day moving average. So they kind of coincide. And this correction, again, not caused by the coronavirus. It's more that the market has been running up like crazy. So of course we're going to get some type of mild correction. So right now the market has gone 74 days without a 1% drop. That's the fourth longest streak in over 20 years. Well, that's the streak that we just saw that was just broken. But this chart shows the market returns after similar runs in the past. You can see here down 10%, down 11%. This is really bad. I mean, down 84%, but that was the 99 tech bubble. And you got down 12, 15, 13. So it's not out of the question to see a bigger drop. But you'll also see here that a lot of the drops, they recovered and the bull market continued. So I would not say this bull market is over. It's still strong. Everything still looks good. It's just a correction. You can look at some other stats that show that a correction might be coming. So market breadth is deteriorating. Here you can see the percentage of stocks trading above their 10-day moving averages is very low. So as a broad group, the market is falling. It's not just a few dragging it down. Also, the New York Stock Exchange new highs over new lows is super low, meaning there's a lot more new lows than new highs. You'd want to see that correct itself before the market continues higher. And these are all breadth indicators. You kind of look at the entire market and see how it's doing, and that gives you a better idea versus sometimes the market gets like pulled up by an apple, or it could also get pulled down by an apple just because they're so big. So you want to look at total breadth. If we look at sentiment, which we always do, the 3 and 10-day moving average of the call put ratio are 2 standard deviations above its average, one of the most extreme readings in this cycle. And that means that investors are buying a lot more calls relative to puts, meaning they're super bullish. You see here, this red line is really high because calls are the right to buy stock. So if you're buying calls, you think the stock market's heading higher. And the last time you see all these red marks, the last time it hit these levels. And the last time it hit these levels, you see all these red marks where it occurred. You see a nice little dip. Like I always say, sentiment is a contraindicator. If people are too bullish, it's not good. If people are really bearish, it is good for stocks. So that's kind of how you want to read those sentiment indicators. And these sentiment surveys were just showing everyone super bullish. The retail crowd was finally incredibly bullish. They had their highest level since January 2018. And then advisors became super bullish too, most since October 18th, right before the large sell-off in the equity market. So again, all that bullish sentiment, not good. Needs to reset a little bit. But this is one of those opportunities where you could add to your positions on the dip because like I said, bull market's still strong. So like Alex says, the play here is to have a list of stocks that you've been watching and wanting to buy, then start building position at a discount as the sell-off progresses. A good indicator of which stocks will outperform in their follow-on leg higher is to see which ones are holding up the best during this market sell-off. A stock that stays higher in sinking waters is a stock that's being held by strong hands. Oh man, is Tesla one of those stocks? Are Tesla bears gonna get crushed even more? I hope so. Stupid Tesla cute idiots. Funny to see strong hands in Tesla. And yeah, if you want help looking into stocks that should explode higher, get our explosive checklist. We put this together from all the research we've done over the years, what's worked for us. We've distilled it down into 10 factors. I think it's 10, maybe it's 9, that you gotta look for in each stock. It's super helpful and it's free. Just click the link down below in the description or comments and you'll get it. So get that guide and also like this video. Comment down below with something. You know I love comments. Tell me your coronavirus stories, I guess. I really hope you don't have any. I joke about this stuff, but I really hope no one gets sick. It is dangerous, but it's been blown out of proportion a little bit too, I think. And hopefully those aren't my last words. But yeah, comment down below, subscribe, hit that notification bell so you get email notifications of our new videos. We're publishing a lot. And remember, stay fallible out there. Bye.